Welcome back, everyone, to a brand new explainer. I am absolutely thrilled to have you here today because honestly, we really need to sit down and decode something that is fundamentally shifting the ground beneath our feet. I want you to just think for a second about a very real, very deep frustration that so many people are feeling right now. You're working harder than ever, right? You might even be earning way more than you used to, and you're saving absolutely every single cent you possibly can. Yet somehow, despite doing everything completely by the book, you can afford less. If you feel like the finish line for just keeping the fridge full or buying a home is constantly moving further and further away, you're not crazy. Today we're going to decode this modern wealth gap by looking closely at a really fascinating new analysis. We're going to unpack exactly why this is happening and, more importantly, how you can actually get off this treadmill.
Okay, let's dive into this. Why does saving dollars in 2026 feel like a losing game on a continuously moving treadmill? Well, the source text we're analyzing today argues that the old rules of personal finance have essentially expired. It poses a pretty tough question. If you're doing all the right things, why are you still losing the war for your money? To really understand this, we have to look way past the surface-level symptoms and dig into the actual mechanics of our current economic environment. We literally have to look at what the money is doing. So, to make sense of all this, we're breaking this explainer down into 5 distinct parts. First, the illusion of saving. Second, the core concept of the Great Repricing. Third, the AI energy supercycle. Fourth, hard assets. And finally, a concrete investor's risk playbook.
Starting with Section 1, the illusion of saving. The source analysis draws a really sharp line in the sand between two types of people in today's economy, the cash holder and the asset owner. You see, when governments inject massive liquidity into the system, it creates this huge structural wealth gap. Take the cash holder. According to the text, this person is actively being punished by inflation because their purchasing power is just shrinking day by day. On the flip side, the investor and the business owner, the asset owners, actually see their assets repriced higher. They're building wealth not because they suddenly decided to work twice as hard, but because they're holding the very vehicles that capture all that flowing liquidity. Let's move to and see how this builds into Section 2, the Great Repricing. You know, when most people hear the word crash, they completely panic. But the author of our source material actually wants us to grasp a totally different concept, repricing. The Great Repricing is defined as the phenomenon where all this excess liquidity flows straight into assets. Think about it mechanically for a second. When you have more dollars out there chasing the exact same amount of assets, whether we're talking about real estate, stocks, or commodities, the prices of those assets inevitably shoot up. Meanwhile, the actual purchasing power of the fiat currency in your pocket goes down. The asset didn't magically become more valuable, your currency simply got weaker. To put this into perspective, the text points out a truly staggering data point. The US dollar has lost roughly 10% of its value just this year alone. 10%! Now, the author notes that the dollar isn't completely dead, but global confidence in it as a stable measuring stick is undeniably weakening. When your measuring stick shrinks by 10% in a single year, trying to save your way to wealth using that exact same measuring stick, it becomes mathematically impossible. And this brilliantly illustrates the mechanics behind it. The source brings up an incredible example where the government printed a $20 billion liquidity injection just to step in and save the Japanese yen. The key takeaway here is that when this kind of money is created, whether it's for foreign exchange interventions or stimulus checks, it doesn't just vanish into thin air. It flows. It has to go somewhere, and it consistently flows right back into assets. Moving right along to Section 3, the AI energy supercycle. I absolutely love this visual metaphor straight from the text. It says our electrical grid is, quote, Christopher Columbus old and wasn't built for the electricity monsters we call AI data centers. It's a funny way to phrase it, but it hits the nail on the head. The author argues that an energy supercycle is already upon us, and it's forcing a complete, immediate rebuild of the electrical grid. We are quite literally racing to build the infrastructure of tomorrow on a crumbling foundation from yesterday. And you can literally see the massive capital flowing to fix this problem. The text highlights how tech giants, specifically pointing out Amazon, are making massive billion-dollar bets on nuclear energy. Why nuclear? Well, because artificial intelligence simply cannot survive without constant, uninterrupted power. This isn't like some software spending that a company can just pause for a quarter to save a few bucks. This is a physical infrastructure race. Once the starting gun fires, it cannot be paused. The real wealth here is being generated by those who actually own the power generation and the infrastructure itself. Which brings us to Section 4, hard assets, specifically gold and silver.
So if our unit of measurement, the dollar, is losing its value, the smart move outlined in the text is to shift money into things the government absolutely cannot print out of thin air. The author states that buying gold right now is basically non-negotiable, but it's super important to understand how they frame this. It is not framed as a bet against America or the economy. It is framed purely as insurance for your family. The text points out that central banks are accumulating 1,000 tons of gold. They definitely aren't doing that for no reason. They're buying insurance, and the author strongly suggests individuals should mirror that institutional behavior.
Now, what's really interesting about this slide is the author's take on silver. They literally call it the new oil. It's not just a precious metal in this context, it is critical industrial infrastructure. You literally cannot build a single AI server, an electric vehicle motor, or a solar panel without it. It's an absolutely indispensable physical component of that infrastructure race we were just talking about. Building on that technological need, the source details a very specific strategy regarding what they call the AI memory stack. The analogy they use is just brilliant for understanding the hardware dependency. Think of it like this. If AI chips are the brain of the operation, well, AI memory is the oxygen. If you cut off the oxygen, the AI brain completely stalls out and dies. So, to position yourself effectively in this cycle, the author argues you have to own the memory, the oxygen that keeps the whole AI system breathing.
And finally, Section 5, the investor's risk playbook. So the crucial point is execution. The text emphasizes that you can't just go out there pressing buttons and chasing every crazy headline. You must have a strict mathematical system. The author actually outlines 3 clear rules to follow. Step 1, a 10% loss, that is your caution light. It tells you to pay attention. Step 2, a 20 to 25% loss is a hard, non-negotiable exit. Why? Because you would much rather keep 75% of your capital to fight another day than become a trapped buyer holding onto a sinking ship just hoping it turns around. And step 3, look for the leaders. You want to find companies that are doubling the S&P 500's performance, because that kind of explosive momentum tells you that massive institutional money is already loading the boat. We're going to wrap up this explainer with a final, really provocative thought from the source material. The author suggests we are currently in a financial state of emergency. Look, you cannot change the macroeconomic headlines, right? What you can control is whether you remain a consumer, constantly paying higher prices with devalued currency, or whether you decide to become an owner. Are you ready to step off the treadmill, own the hard assets, own the infrastructure, and truly protect your purchasing power? It's a fascinating perspective on the shifting global economy, and it's definitely something we all need to seriously think about as we strategize for the future. Thank you so much for joining me to unpack all of this, and as always, keep learning.